just want to welcome everybody. Ramis Fakori here from the IRA Club. We are a self-directed full administrator based out of Chicago, Illinois. If you're so in particular, we're here to joining us actually is going to be Chris, Kyle, and Ben from MJ Reit.
My name is Chris Reese. I'm the CEO of MJ Reit. I've been in the asset management space today for almost 28 years. The first half of those were spent on the public side, the last 14 on the private side. I launched MJ Reit in the summer of 2022, and we had our first full month of performance in September of 2022. So April completes our 20th month of performance, and we'll talk a little bit more about that as we go through the presentation. Our sub-manager on MJ Reit is Rainbow Realty Group, and I'm very excited to have both Kyle Schenfeld as well as Ben Bolanos on the phone with us so they can talk a little bit more about how they diligence the opportunity. So from Kyle's standpoint, obviously the slide says, welcome Chris Reese. That's Kyle Schenfeld and not Chris Reese.
Kyle, I apologize, good sir. That was completely my fault. So that is my bad. Well, my apologies, Kyle.
No worries. Calling me Chris Reese is a compliment, so I'll take it.
Well, and Kyle, for his side, has been in the space for a little over 10 years now, and currently serves as the CEO at Rainbow Realty Group. And also joining on the call is Ben Bolanos. Ben is the Chief Operating Officer at Rainbow Realty Group, and Ben comes with about 13 years of experience in the space. So before we get into the presentation, just a high-level overview at a basic level of what MJ Reit truly is. We are a private real estate fund that seeks to take advantage of an opportunity within the real estate space that's based on commercial real estate property that happens to have a cannabis tenant. And because of that cannabis tenant, as Ramis pointed out earlier, it excludes the owner of that building from going to your traditional financing sources like Wells Fargo or JP Morgan. And so this is the niche that we tend to focus on. So as Ron mentioned earlier, we do not lend directly to the operator, but rather finance a piece of commercial real estate that the owner of that real estate happens to have a cannabis tenant. And it's that little niche that allows us to earn a better risk-adjusted returns, as well as the potential for additional upside. So with that said, let me take you to the presentation, and we'll spend a little bit of time going through some of the slides. My goal is really to provide a high-level overview in the beginning, why we believe that real estate is an attractive area of the market. We'll focus on for just a few moments on the differences between private and public real estate. And then we're going to get into the meat of the presentation today, which is focused on really an educational component into the cannabis space, some of the nuances that are associated with the cannabis space, and how you as an investor could potentially gain exposure to the area without actually investing in the operator or touching the plant itself. So you're going to hear us refer to this term of touching the plant versus non-plant touching investments. And for us, it's the opportunity to finance that real estate, so we're not directly touching the plant, and that's very important to highlight. So from a real estate standpoint, I want to spend just a second going through the benefit of real estate overall. So real estate is the third largest asset class in the United States behind fixed income, which is a little over $50 trillion, and equities, which is just below $40 trillion. So real estate comes in at about $21 trillion. But the difference between fixed income, real estate, and equities is that we believe ultimately that on the real estate side, you get the best of both worlds. So not only do you get the income orientation that's typical in a fixed income product, but you also get the potential for additional upside or appreciation through the underlying properties appreciating in value. So we believe that real estate offers a unique aspect. In addition to just providing the income component and the appreciation component, real estate has traditionally provided a hedge against inflation. And we've heard a lot about inflation and Fed's fight to bring down that target number. But if you look over the longer term, real estate has generally outpaced inflation and presented investors a way to hedge against that inflation. But it's not only the inflation benefit that investors can enjoy, it's also the consistency of a distribution or income from those assets. Now, keep in mind, this is the broader real estate market and doesn't touch specifically on the opportunity that we'll mention or talk about in a couple of moments. So if you look over the last 20 years, 85% of the time in private real estate, you've earned an annual income of in excess of 4%. Now, that doesn't sound like a lot, but over the longer period of time, it certainly adds up. But the benefit of what we do and the target of MJ Reit is we seek to provide investors with a nice monthly distribution of 10% or greater. And to put that into perspective, in the month of March, we actually paid a 15.48% annualized distribution to our investors. So we have protection against inflation. We have a consistent income. And then lastly, private versus public markets, because there are ways to gain exposure to real estate. You can go and take a position in a private real estate fund, or you can take and buy a publicly traded REIT. The difference between the public versus the private REITs are, generally speaking, you'll see enhanced volatility within the public market of publicly traded REITs. Because if you think about it, those REITs and the prices are driven really no different than an underlying publicly traded stock based on investor sentiment. So private REITs aren't traded on a daily basis, but rather traded on a monthly or quarterly basis. At MJ Reit, we value the fund on a monthly basis and allow purchases and redemptions subject to some policies also on a monthly basis. And so what we've seen over the longer period of time is that private real estate tends to exhibit lower volatility than the public side of the market. So that as a backdrop, I want to spend a couple going through the aspect of cannabis and bringing Kyle and Ben to talk a little bit more about what they're seeing in the marketplace. And I'll start off this slide and then maybe transition to Kyle or Ben if you want to make a couple of points as well. It would be helpful. But just for those that don't follow the cannabis space as closely as we, if you go back to 1996, California was the first state that legalized cannabis for the medical or medicinal level. Since that time, we've seen a continuation of more and more states legalizing on at least a medical basis, and some have both medical and what we'll refer to as adult use or recreational basis. Those terms are interchangeable. And so today we have 40 states, DC, and a few US territories that allow for at least medical cannabis programs. And from a state standpoint, you heard Ramesh talking about taxes. Taxes are a big driver of why states, especially in the beginning, began to legalize, because as states become online and go from restrictive policy to medical and then ultimately recreational, you generally see an increase in cannabis sales. That means tax revenue increases, and that means the state's budgets have more money to fund social services, pave roads, et cetera. So we've continued to see this migration, and even the state of Pennsylvania, my home state, which potentially has the ability to legalize on an adult use basis in 2024, the governor looks at the neighboring states, and 5 of those 6 states have adult use programs. And so, if you didn't have the med card and lived in Philadelphia, you could go right across the bridge to New Jersey and buy adult use cannabis, and New Jersey collects those taxes as opposed to PA. So that's the market continues to evolve. There has been some additional news, and maybe Kyle or Ben, if you want to highlight some of the nuances with what the DEA said, and also share insight that you have specific to the cannabis markets, that would be helpful.
Sure. I can jump in. Maybe one point that you mentioned, Chris, which I think is really important, is you said Wells Fargo and JP Morgan kind of can't or at least won't do this. I really want to emphasize that point. Rainbow, we got into this industry about 6 years ago. And when we first got into the industry, I would say there was maybe 10 times the demand versus supply, 10 times the capital needed for real estate projects than there was capital providers. Since that time, like you can see on this chart, there's way more states that are online, but the set of lenders has not increased. I'll mention what rescheduling is in a second, which is a great boost for the industry. But as a general matter, there aren't more lenders in the space. So today, I think it's 30, maybe even 40 times the demand relative to supply in this industry. And we stick to our real estate strategy, right? It is just a a standard kind of senior secured mortgage secured by a piece of retail or industrial real estate. But because of the supply demand dynamics in this industry, one, we're incredibly selective with who we actually do business with. We do one, maybe two out of every 100 deals we look at. So it affords us the opportunity to be, very picky. And second, Chris mentioned some of our returns. We charge very high returns. We're doing deals that we think are very safe and secure with strong counterparties, but we're also charging considerably higher than traditional real estate rates. Again, it's because there's such a mismatch of supply versus demand in this industry. We can get into our history and my family's history. We've been in real estate for 65 years. We've run 2 public companies. We've always known real estate. We think this is the most mispriced real estate trade we've seen in 6 decades. And that's why we're taking advantage of it. Specifically, Chris, if you want me to talk about rescheduling, recently the DEA announced plans. It's not official yet, but there's strong reason to believe that cannabis will be rescheduled from a Schedule 1 to a Schedule 3 narcotic. The effect of that is pretty massive for the companies themselves. Essentially, today they're taxed off of revenue rather than net profit. Rescheduling would effectively have the companies taxed just off their profit, which would make a large portion of the industry go from barely breaking even or actually losing money to breaking even or making money. So rescheduling would be a huge win for the industry. From where Rainbow and from where MJ Reit sit, it's really interesting because basically, as I laid out, the bottom line from our borrowers and our tenants is going to increase substantially. We're going to get a boost in the creditworthiness of our counterparties, which is great. But at the same time, rescheduling is not safe banking, which is targeted bank reform for the industry, and safe banking is not legalization. So in my estimation, again, you'll see a much improved caliber of counterparty from where we as the lenders sit, but you won't see massive, competition and lots of new lenders coming into the space. I think it will require real legalization or at least banking reform to get there. And so at Rainbow and MJ Reit, we're in a really interesting spot where, like I said, we got to boost the creditworthiness of our counterparties, and at the same time, it's a non-competitive environment and we're getting really high returns. So rescheduling is great for the industry and probably even better for MJ Reit. And Chris, I don't know if you want me to add anything now, but I could toss it over to Ben as well, or you can keep going.
Yeah, I don't know, Ben, do you want to add anything to that? Or?
No, I think, obviously it's a massive win, federally where, besides the Cole memo a number of years ago, which was later rescinded, there really hasn't been any federal, changes in the cannabis program. And you're looking at your screen at the state change, we're at 40 medical states, I believe 24 recreational states. So we're still seeing locally within states continuously, expand their cannabis program. So that ties into what Kyle was talking about. We're seeing opportunities in states like California, which I think had 5 billion in sales in 2023, and markets like Michigan, which are newer markets with 3 billion in revenue in total sales. And we're seeing the East Coast, follow with their change from medical to rec. States like Maryland, which just legalized, went from a from medical to recreational, did 700+ million. States like New York, Connecticut, New Jersey, great population markets where we could find a lot of opportunity. Where we're based in that area, and now we're starting to see the Southeast, the Carolinas, also start to talk about medical programs. So in a number of years, regardless of the federal changes, this map is going to be all lit up, and we're going to be close to 50 states with medical, and I'm sure 30, 40 states with adult use. So, the trend in America is clear. We're just
Sorry, Ben, I think we're losing.
Ben. Yeah, I got you guys.
There you go.
So So I guess as I'll kind of jump back in here, and really, if you think about it, what creates this opportunity is there is a simple mismatch because at level, cannabis is illegal as a Schedule 1, and at the state levels, you have states saying, "Hey, we're going to allow these sales to occur," and it's that mismatch that allows the opportunity that Kyle just spoke about, where in their estimation, it's one of the greatest opportunities that they've seen in the 6+ decades they've been.
There is Kyle. I'm sorry, Chris, Kyle, and Ben.
Yeah.
There is somebody who actually went inside the private chat and says, "What about Texas prospects?" And then just a question mark. Is there any reason why they haven't focused on Texas at all?
Texas has a limited medical program. They gave out a few licenses. I think it's going to continue to expand their medical program. I'm not sure if rec is on the radar of the politicians locally, but the consumers want it. In many states, where they do polling, on constituencies, there's very high adoption rate of people who want medical. I think it's like 70 or 80% plus in most states, and recreational, where it's 55 to 60%, and in many states higher. And there's concerns of crime and getting it to children. But the states have put good safeguards in place to make sure the industry is, in fact, over-regulated, to making sure that people know what they're consuming. It's sold in an environment that's restricted. And so I think states will continue to adopt it. Texas is just, in that sort of southeast quadrant that's a few years behind the Northeast, which was behind the Midwest, which was behind the West Coast. So it's coming, but that'll be a late adopter.
Moss, I hope that answers your question. I hope that answers your question. I'm just under the assumption that you live in Texas, so I hope that answered your question.
And I always think too, when we talk about the idea of cannabis, it's really the challenge creates the opportunity. And I always like to spend a couple of moments going through, why we believe this industry offers investors the opportunity to earn better or outsized returns. And the first, and we talked a little bit about this, is the industry growth characteristics. Kyle and Ben hit on that. We talk about lack of traditional financing. So going back to the idea that you can't go to a Wells Fargo or a JP Morgan to get financing. And the third, which is somewhat unique in this space, is that there's limited to zero institutional involvement. And if you combine those three characteristics, that gets us to be what the opportunity is. We see it. We see it as a great opportunity to take advantage of a market that has these mismatch between the growth, the lack of capital, and limited institutional involvement. And when you can do that, generally, and if you look historically, you've been able to earn outsized returns for investors when you do that. So just a quick update on the overall market itself. And so for those that don't again traffic in this area of the market as frequently as we do, cannabis is a growing and an enormous area of the market, and its impact from an economic standpoint can't be understated. So in 2024, it's estimated that adult use cannabis sales will be $32 billion. Actually, this is all in. If you look at it, and these, I just noticed these are off a little bit. It's not a difference between medical and adult use. But if you look at the cannabis sales in 2024, it's about $32 billion. And it's estimated to go up to about $58 billion in 2030. But the blue bars show the economic impact that cannabis sales have, and it's a trickle-down effect. So as states open up and a cannabis dispensary or cannabis cultivation takes root, the operators of that will have an impact on the overall economy because they're hiring people, and those people that they hire are going to spend that money in the overall economy for food, for fuel, for living. So it has a huge impact. And in some estimations, if you were to combine the legal cannabis sales with the illegal cannabis sales, because there's still a large black market, if you were to combine those two, you get somewhere north of about $100 in annual sales. And that would compare to sales that you would see in tobacco, alcohol, and wine. So I guess where this slide is going and the point I'm making is that the cannabis market is a huge market and it's going to continue to grow as we go forward. So I want to spend a moment before kind of getting into Rainbow and some of the background on the sub-manager of the fund. When we created MJ Reit, it was really about taking the public side of the market and the private side of the market and bringing that together and an investment for investors to be able to gain access to this area of the market without taking on the undue risk. And because MJ Reit is taxed as a real estate fund or as a REIT, there are some tax advantages that are highlighted here. Now, keep in mind, this doesn't necessarily affect or benefit within an IRA account, but just so you know, distributions that are paid on a taxable account do qualify for a 20% deduction on ordinary income off of the federal taxes. So it's an opportunity on the non-taxable side to also take and potentially make an investment in MJ Reit. And from our standpoint, over the last 20 months, we've had consistent performance, and we've been able to generate attractive overall returns for our investors. So our annualized since inception return stands today at 11.04%. 100% of the distributions that we paid to our investors are fully earned. We have zero leverage on the fund. And the most recent month, which was in the month of March, we're calculating today the April distribution, but the month of March, we paid a 15.48% annualized distribution to our investors. So our income is fully earned, and we have zero leverage in the fund today. So very happy and very excited about the performance for our investors that they've been able to enjoy along the last 20 months. At this point, I want to transition a little bit because I think it's important to understand the sub-manager and kind of transition to both Kyle and Ben to talk a little bit more about Rainbow. And maybe Kyle or Ben, if you can give also, as you're going through the background of Rainbow, if you could highlight a deal or two that you see in the marketplace and provide a little bit of insight into how your family is also very much involved in the underlying assets and the funds you manage.
Yeah, sure. I'll start backwards, go to Rainbow last, but I'll start with Gould. So Gould Investors is, as Chris says, it's my family's business, private company. Gould is a creative real estate investor. Been around for, it was originally called Gould Properties, but it was founded in 1962. Gould is the controlling shareholder of the two public companies that we run, One Liberty Properties and BRT. I'll talk about them in a minute. But like I said, Gould's done all sorts of creative niche real estate strategies. We bought banks back in the day. We invested in stadium movie theaters before it was a popular asset category. Somewhat similar to cannabis. Cannabis is way more mismatched, but similarly, stadium movie theaters were not a popular asset class. We bought a bunch of them at 12 caps. As people realized it was a good asset class, more capital moved into the space, and we sold them at 8 caps. The cannabis trade is very similar, right? You're getting higher cap rates or higher interest rates than the assets justify because people are afraid of or precluded from investing in the space. So again, Gould is the private company. It does all sorts of stuff. Gould is also the largest investor in Rainbow. So we're very aligned with our investors. We're like 30% of the LP capital. We have a principles mentality and we're very conservative. The reason being is we're the largest investor ourselves. One Liberty Properties, I don't know, Jill can't hear me, but I'm going to keep going. I'll try to speak up. One Liberty Properties is one of the 2 REITs that we run. It's a triple net lease retail and industrial company. They operate in 43 or 44 states today. The asset class, like I said, is retail and industrial. It's the same asset classes that Rainbow works with. We have a lot of familiarity with those assets, re-tenanting those assets, brokers who know local markets, etc. Ben actually spent about a decade of his career working at One Liberty before he partnered with me on Rainbow. And then BRT Apartments, formerly a lender until about 2008. We switched it over to a multifamily apartment REIT. The company owns about 10,000 apartments, primarily in the Southeast today. But in its previous life, it was a lender, which is a large portion of the business Rainbow does. So again, as a family, as an organization, we have a lot of experience with, sale leasebacks on retail and industrial, and senior and mezz lending on other commercial real estate. And then Majestic Properties, just our in-house property management company. We have a shared services agreement with the broader Gould organization. So we use Majestic for property management and billing and all of that. But yeah, like I said, backing into Rainbow, Gould Investors is the largest investor in Rainbow. The investment committee of Gould Investors is one and the same with Rainbow. So anytime we have a transaction or we want to spend a certain sum of money, we have 7 people with over 200 years of real estate experience on our committee. We generally vote by unanimously. So again, point being is we're a very conservative group. When we look at a deal in our investment committee, it's nice if it's a 22% IRR as opposed to an 18, right? But really, we're hyper focused on is, what happens if things go the wrong way? What is this asset actually worth? How long will it take us to re-tenant it? How do we make our money back if things go sideways? And by investing with that strategy in mind, in the last 6 years, we haven't lost money on a single deal that we've done in Rainbow. And it's a testament again to our conservatism and the way we value real estate at its alternate use, non-cannabis basis, rather than some highest and best use, which is above and beyond the traditional real estate basis. That's kind of look at our whole organization. And again, we at Rainbow have a shared services agreement with Gould, so legal, accounting, billing, property management, as I mentioned. We run all that through our mothership, which has about 70 employees, and it allows us to work very efficiently. So that's kind of how the partnership works.
Yeah, and I would highlight a couple of points that you mentioned, Kyle. First and foremost, if you look at the broader Gould organization, you're looking at about $2.5 billion in total real estate value. Within Rainbow Realty specifically, there's about about 150 million dedicated to the cannabis space. And most importantly, what Kyle said, and I really want to hit on this point, is when they go in and evaluate a deal, they're using what was an alternative use valuation. So you can think of it as the base case scenario is that cannabis goes away and they need to find another non-cannabis tenant for both the industrial side or on the retail side, maybe a coffee shop. And what could that building be sold or leased for? And that's the big difference between what we do and potentially other investors in the market, in the marketplace. It's a really, really important distinction. I want to make sure that everyone's clear that each one of those deals that we get into, we're looking at and valuing that property from an alternative use valuation. And Kyle, or maybe Ben, and generally what happens, and maybe walk the attendees through when you get let's say we get a cultivation license at 123 Main Street, and maybe walk everybody through the value that's associated with that, because generally that value goes up. But again, kind of tying it back to where you look at the building from an alternative use value point and point out some of the differences there as well.
Sure. So, I think what you're pointing at is, the perception of the value of a license. When we've seen, people win these licenses off the bat, there are trades there. People sell and flip these licenses, but over time, when states issue more licenses, the market becomes more competitive. And so, there were lenders who were valuing licenses as part of their collateral, right, or equipment, enterprise value. We stick to underwriting the property, right? So if it's an industrial property, we're going to spend the time to understand that market, understand, where we think that property lies within that market from a rent perspective, from a market demand perspective, from a cap rate perspective. We're going to also underwrite the building itself. What does it cost to, re-tenant it? What improvements are needed to be made? Roof, parking lot, HVAC, all the systems. And so we're going to underwrite that building and have a business plan that's ready to go if or, for whatever reason, one of our tenants or borrower stops paying, we have a plan, pre-written, if you will, a strategy going in to how we'll get out of that property. And I think that sets us apart because in many cases, the assets that are at the property that are part of our collateral, the licenses and the equipment, lends itself to actually being able to make money and going to other cannabis operators within the industry and saying, hey, we have a fully built out cultivation facility, and there is a premium in that to the market. And we've seen it time and time again. People will pay up for that. But, we underwrite to that scenario where that's all worthless. So, the reality is that there is an immense value in those assets, and we capture that value within our loans. So really, or within properties we own. So really, we have actually a better collateral package. And, to Chris's initial point, creates a mismatch in, risk return, because we're taking actually less risk than traditional real estate investing, but getting a return, 2-3 times traditional real estate. So it's a really great backdrop for us to do deals right now. I think hopefully that answered some of your question there.
Yeah, and I think to put some numbers around it. So let's for example say that Ben, Kyle, and I went out and we identified a cultivation site, and we we're in the state of New Jersey. We get the cultivation license, and we buy that building for $2 million. Well, we may have to put $6 million into that to increase the security, the HVAC, the irrigation, all of the internal aspects that are needed to cultivate cannabis. So in our mind now, the building is worth $8 million. But to Ben's point, that building isn't worth $8 million to MJ Reit and to Rainbow, because they're going to underwrite that deal as if the value of that building is maybe $2.5 million, not $8 million. And that's the critical point, which is what sets us apart in the marketplace. Because again, we assume that cannabis goes away and we need to find an alternative use for that particular property. If you have, maybe share some of the dynamics on one of the most recent deals and how, given that lack of capital, we're able to negotiate some additional upside for our investors.
You want me to take that one?
Yeah, you take this, Ben.
So yeah, we did, and I'm sure Chris can share information on the portfolio of assets that exist in MJ Reit today. But one of the pools of assets is a series of loans, mortgages against properties that are owned in Ohio. Ohio was a medical only state when we did the loan in the end of 2022. 22, correct. And last year, Ohio flipped from medical to recreational. And so the owners of the real estate started to sell off some of the properties. And what we negotiated within the agreement is a that. So, Chris published a 51, I believe is the number, IRR on some of those payoffs. It won't be typical that we'll be able to generate 50% IRRs on our loans. But in that unique case where we were able to participate in the upsize through this participation, when the business plan worked out, we were able to hit that type of return. And in other cases, we'll be able to negotiate equity kickers, stock kickers, warrants, convertible features within our loans. So if the business is successful, right, or the business plan works out, we'll be able to achieve, IRRs on our investments above the underwritten loan, which, anywhere from 15 to 20, low 20% is what we're targeting in this market. So, again, it won't be typical, but we are seeing opportunities to get those type of structures, just given the, the mismatch in supply and demand of capital needed within this space. So,
that's great.
I think it's just,
Thank you, Ben.
I do think it's a really good example of like how different the lender's landscape is in cannabis versus the traditional real estate world. Because again, like we made a loan that was, I don't know, 75% loan to value, your very basic loan. Yes, we charged, a mid-teen interest rate, which is not customary unto itself, but like the fact that we could charge that rate and take a participation in the sale of the property. I mean, I've my family's been a lender for 35 years. So I don't think we ever structured a deal like that. So Ben's right. It's an unusually high IRR. Like, I think our investors in Fund 4 project to earn around a 20% net IRR. We could do better, but that's kind of what we project net. But it highlights just how much extra kind of leg we have to stand on in this position when, again, there's so few capital providers and there's so many borrowers who need capital. It puts us in a really strong negotiating position.
Yeah, and within South MJ Reit, we're striving for a 10% total return derived mostly through monthly income. Our monthly income has averaged anywhere between 10.2% on the low side to the most recent March payment, which was a little bit of an abnormal payment today, which was at 15.48. And so I'd rather under promise and over deliver. And as Kyle and Ben continue to deploy capital in the market today, I expect those rates to continue to increase. Specific to the fund itself, and David asked a question about the fees. And so our standard fee on the fund itself is 1.5 and 15. And so that means we have a 1.5% management fee and we have a 15% incentive fee. There is a 7% preferred return to our investors. We've been well above that on a monthly basis since inception. But there is that all of the numbers that I'm referring to are all net of those fees and expenses, and there's no additional fees in the fund. And Rainbow, as the sub manager, and MJ Reit, we split those fees, so there's not an additional layer of fees that are charged on the fund to investors. Also, very important to point out, the standard investment, and Karen had a question on this. Corinne had a question on this. It's listed at $25,000, but because of the relationship and the launch that we have at the IRA Club, we lowered that investment minimum to only $10,000. I looked at it as an opportunity for everybody on the phone and IRA Club members to kind of dip their toe in the water, if you will, and take a position in the fund. And not only have we lowered our minimum, but keep in mind that the first year $195 service fee is waived for you through MJ Reit as an investment within the IRA Club framework. So we waived that 195. Yeah, waived that 195, and we also have reduced the minimum, really to make this strategy as appealing to as many investors as possible.
Yeah, so Chris, I just wanted to jump in, if you don't mind, 2 seconds. Yep. IRA Club members that are listening, when you guys ask me all the time, what are some investments that are unique? What's out there that's different in the alternative space? I know many of you understand real estate deals and multifamily deals. The reasons why it makes MJ Reit and Rainbow so unique is the cannabis aspect of it. Okay, many of you in the past have asked me, is there, can we invest in cannabis? Well, MJ Reit has figured out a way, I want to say respectfully, how to bend the rules using your retirement dollars and invest in the actual facilities themselves. As they mentioned, the cultivational centers. So you're not, again, investing in the actual plant. You don't have to worry about the prohibited transaction. You're investing in the actual infrastructure of the company. And then in turn, the plants obviously do grow. They sell them off, and that's how they get to pay the investors off. Keep in mind, I know that you guys, when we talk and when we educate, we're talking about retirement dollars. It does not mean you cannot use your personal dollars. We educate both sides. Diversify your personal dollars and also diversify your retirement dollars. And keep in mind, Chris, can I ask you this question? If somebody, let's just say, has rental income coming in from one of their properties and it tacks up to be about $5,000, can they partner their personal dollars and their retirement dollars together to invest in the REIT?
Sure, absolutely. We can combine those.
Awesome, good to know. Go ahead. I'm sorry, Chris.
And another two quick points, and then I'll turn it back to you, Ramis, for final closing questions. First, this is a strategy that's open only to accredited investors. I know there was a specific question on that. And then secondly, we didn't hit on this when we talked about the deals. These are not long dated senior mortgages that we're underwriting. generally the maturity is between 2 to 4 years. And so this is capital that we're providing to these borrowers. We're financing a piece of commercial real estate going up to 70, 75% LTV. And it's capital that generally is paid off within 3-4 years is the maturity schedule. So these aren't long dated 30-year mortgages that we're writing. It's much, and then we would simply recycle that. So we have a deal that pays off. We take that and we invest that capital in a new deal for our investors. We have monthly purchases, so we close once a month at the end of the month. It's a simple process that Ramesh can walk you through. Monthly redemptions, and so if you do redeem in the first 12 months, just as a full disclosure, there is a 5% redemption. After 12 months, you get at 100% of the net asset value, and we pay our distributions on a monthly basis as well.
You talked about the positives. Can you talk about some of the risk or the volatility when investing?
Yeah,
you're saying when investing with MJ Reit.
Yeah, absolutely. And from my standpoint, it's really, and I'll let Kyle and Ben dive into this. It's for us that the biggest risk itself is really no different than any other fixed income investment. And it kind of gets to the point of the due diligence that each and every property goes through, which is that we lend $5 million to finance a piece of real estate, and the owner of that real estate, for whatever reason, fails to make that interest payment, defaults on the loan. Ultimately, what that does to the fund is there will be in the near term a decline in the interest because we're not collecting the interest. Ultimately, that will work out as we come in and find another tenant or sell the property. So for us, for me in particular, and Ben and Kyle, you can add to this. It's really the potential risk of a borrower not meeting their obligation.
All right. So Chris, final thoughts go to you. I always like to leave with a closing statement with our generous host for taking the time. So please, if there's anything you would like to say to the IRA Club.
I think in closing, I just wanted to thank everybody for their time today. Ramesh, thank you as well for your time. Ben, Kyle, thanks for joining as well. We look at this as an opportunity that is not going to last forever. It might be 5 or 10 years before there's substantial change, but this is an opportunity to earn better risk-adjusted returns than going in and potentially investing in, let's say, some other component of the real estate market because of the thematic cannabis approach and the conservative underwriting that Rainbow has. So I'll leave it at that. Thank you again, everybody, for the time, and we look forward to having some follow-up conversations.
Thank you. Thank you, everybody. Thanks, Kyle. Thanks, Ben.
Thank you.
Guys.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.